As mentioned in the video about bank runs, deposit guarantees are used to maintain confidence in the banking system. In the United States, for example, the Federal Deposit Insurance Corporation was created back in 1933 to restore people's confidence in banks after the Great Depression. It still exists and insures deposits of up to $250,000 per person per bank. So if someone wants to keep $1 million insured, he can create $250,000 deposits at 4 different banks. The same principle is valid elsewhere in the world. The European Union requires all member states to have a deposit guarantee mechanism since 1994, but lets them decide how much money they're willing to guarantee. After the crisis of 2007 and 2008, EU countries increased those amounts, in most cases to €100,000. So are these guarantees foolproof? Definitely not. The US, since it prints its own currency, is in a good position to bail out depositors without too much bureaucracy. You could say deposits are also guaranteed by the Federal Reserve printing presses rather than just the FDIC, because if a deadly chain of bank failures would occur, the funds the FDIC has and not even its line of credit with the US Treasury would be enough. But even if you'd be rescued by the printing presses in an extreme scenario, you'd be paid in US dollars, which would probably be considerably less valuable. In the EU, things would be even trickier because most countries use the euro and therefore don't have their own central bank. As such, deposit guarantees should be taken with a grain of salt.